Liquidity transformation. Liquidity transformation. In this case, when we talk about liquidity transformation, equal intermediation activity used by banks and similar financial intermediation to manage the run problem or liquidity problem. Run problem or liquidity problem. When this problem happens, this problem when savers or depositors withdraw the deposits from a bank at the same time. Suppose the bank have when we talk about the bank has 100 clients or depositors, okay? All 100 clients or depositors want to withdraw all deposits now. In this case, we talk about run problem or liquidity problem. But this case cleared in the panic and economic crisis, and may be in this case insolvent for the bank and the crisis for the bank. How can the bank meet this problem? By cash reserves. By cash reserves. So the next point, when we talk about the bank provide financial claims to depositors that often greater liquidity characteristics compared to direct claims. So in this case, any bank deposits talk about contract between the depositor and the bank. So for risk, the bank keep sufficient reserves. The bank keeps sufficient reserves to face this liquidity problem. Banks hold liabilities and assets of different liquidity features. So in this case, we talk about classification of assets and liabilities into quick liquidity, medium liquidity, and the long liquidity. Okay, so the cash, it's very important for the bank to face the run problem or liquidity problem. How you can minimize the effects of liquidity problem? Okay, suppose in critical cases like nowadays when we talk about the Russian-Ukrainian war, okay, the war between Russia and Ukraine. In this case, what about the situation for banks on Ukraine? Okay, all depositors want to withdraw deposits from banks in Ukraine. So in this case, the banks or the central bank of Ukraine can do the following. Number one, temporary shutdown of the bank branches. Temporary shutdown of bank branches. Number two, use cash reserves. Use cash reserves and quick borrow from the other institution to get support and ensure deposits by the government. In this case, this is very important. But the run problem or liquidity problem appeared in the case of wars, the case of crisis, and so on. Theory number 4, consumption smoothing. Consumption smoothing. What do we mean by this theory? In this case, we talk about balance between 2 points of time. Balance between 2 points of time. The first one, expenditure for today's needs, and the second, saving for the future. So we compare between, say, I have 1,000 of Egyptian pound now. I have two options. Okay, I will purchase. So in this case, I will provide all my deposit into expenditure now. Another option, I can make a deposit for this value for maybe for 1 year, for 3 months, okay, and they earn interest and make an expenditure in the future. So we compare between immediate expenditure now or saving for the future and make expenditure in the future. So, in other words, consumption smoothing focuses on the behavior of saving when earning a balanced way. Okay, for this figure, this figure we talk about the time, we talk about the time and income and consumption. We assume that consumption is fixed. We assume this is consumption is fixed, but the variable income, the green line, this is income, okay? At the first stage, consumption greater than the income. So what about your action? Borrowing, okay? So we talk about college and buying home and another services. In this time, in this time, when the consumption greater than income, what about your solution? Borrowing. Maybe in the college to complete your education, to purchase a home, and so on. The time or another stage. In another stage, the income greater than consumption. So in this case, we talk about saving. Saving for your working years. Saving for your working years. And saving increase in the first stage to reach to the maximum and then decline. What about stage number three? Stage number three, your consumption back again to greater than your income. In this case, we talk about this saving. This saving, in this case, in your time for retirement or over 60 years. Over 60 years, maybe your consumption greater than your income. Okay? So, in general, we talk about three stages. First one, borrowing when the consumption greater than the income. In this stage, we talk about the college time or education and or you want to buy a home. Second stage, your working years, your saving increase to reach to the maximum and then decrease. In this case, all in all, we talk about positive saving because your income greater than consumption. The last stage in your retirement or over 60 years, when you reach to over 60, maybe your consumption greater than your income, and in this case, this is this saving. Okay. Therefore, banks are an institution that allow economic agents to smooth consumption. Okay, you will think about your current stage and your future. This is maybe you talk about smoothing of consumption. Consumption smoothing relates to the hypothesis of life cycle theory of saving. This is life cycle theory of saving. So in this case, the bank can provide products, can provide some services to help the agents or help the depositors to smooth the consumption. The last theory, when we talk about commitment mechanisms, commitment mechanism. In this case, we talk about or we classify banks into Deposit Taking Institution, DTI. DTI stands for Deposit Taking Institution, DTI. And there are Monetary Financial Institution, MFI. So the bank, DTI and MFI, Deposit Taking and Monetary Financial Institution. In general, banks play a key role in the economy performance as their deposit liabilities from major part of country's money supply and relevant to the central bank. So when the central bank target any monetary policy, in this case, the commercial banks play the key role on this section. Banks deposit function as the money, so in this case we talk about any expansion of bank deposits result an increase in the stock of money or the supply of money. When the bank when the bank expanding in the credit, okay, in this case, the supply of money for the economy increased. Monetary function of bank as a deposit justifies why deposit taking institution subject to hard regulations. Banks as a deposit taking institution subject to hard regulation and supervision from another banks.